$830 billion now sits inside one leveraged Treasury trade. That is the Federal Reserve's estimate for September 2025. The asset is United States government debt, the benchmark beneath global borrowing costs. Hedge funds buy Treasury securities with short-term repo loans. Then they sell matching Treasury futures. The price gap is tiny, so the leverage can become extreme. A separate Federal Reserve analysis estimated 56-to-1 leverage in Treasury-repo positions. That calculation used December 2022 data. Tiny profits become meaningful. Tiny market moves become urgent cash demands. In March 2020, leveraged funds rapidly unwound basis trades. The world's safest market became difficult to trade. The missing link connects treasuries, futures, repo, and hedge funds. When many funds need the same exit, that connection becomes the risk. Take a treasury note worth $100. A related futures contract may imply a price slightly higher than that note. The difference might be tiny. A hedge fund buys the cheaper treasury and simultaneously sells the futures contract. If the two prices converge, the gap becomes profit. That is the Treasury cash futures basis trade. The important word is not treasury, it is leverage. A tiny spread is not attractive on an unleveraged investment. Suppose the opportunity produces only a fraction of 1%. Committing $100 of the fund's own capital may barely matter. But if the fund can borrow almost the entire purchase price, the return on its own capital can multiply. The Treasury note becomes collateral for the loan used to buy it. That loan is called repo. A repurchase agreement, or repo, is a short-term secured loan. The hedge fund receives cash from a lender and provides Treasury securities as collateral. Later, it repays the cash plus interest and receives the securities back. Treasuries are considered exceptionally high-quality collateral. That allows repo lenders to demand very small haircuts. A haircut is the portion the borrower must finance with its own money. This is where the headline needs precision. A 1% repo haircut means roughly $99 can be borrowed against $100 of collateral. But official data do not show every basis trade using exactly 99% borrowed money. Federal Reserve research found something broader. Nearly 74% of qualifying hedge funds' repo borrowing in late 2022 occurred at zero or negative haircuts. Some funding required even less upfront capital. The same Federal Reserve study estimated $553 billion of Treasury-backed repo borrowing in December 2022. The estimated hedge fund capital supporting it was only $9.88 billion. That produced effective Treasury repo leverage of roughly 56-to-1. A hypothetical 2% minimum haircut would have reduced that estimate to about 25-to-1. Small collateral requirements are the economic fuel. The Treasury purchase is only one side. The hedge fund also sells Treasury futures. Asset managers, pension funds, mutual funds, and other investors often want long futures exposure because futures can be liquid and balance sheet efficient. Hedge funds take the opposite side, so the chain becomes clear. An asset manager buys futures. A hedge fund sells futures. The hedge fund buys treasuries. Repo lenders finance the treasuries. That chain performs a useful function. Demand for Treasury futures can push futures prices slightly away from comparable cash treasuries. Basis traders exploit the difference. Their buying supports cash treasury demand. Their selling supplies futures contracts to investors. Their arbitrage pulls prices back toward each other. Federal Reserve and Treasury officials both acknowledge these benefits. The leverage is not pointless speculation. It helps connect two major markets. What changed is the scale. In June 2026, Federal Reserve researchers estimated the basis trade at approximately $830 billion as of September 2025. That was close to twice its early 2020 peak. The estimated positions represented about 3.5% of privately held Treasury securities outstanding. For an arbitrage built around tiny price differences, that is a very large footprint. The basis trade sits inside an even larger hedge fund treasury machine. By September 2025, hedge funds had about $4 trillion of gross treasury exposure. They had roughly $3 trillion of repo cash borrowing. Those are not estimates of the basis trade alone. They include other treasury strategies. But they show how dependent hedge fund treasury activity has become on short-term financing. The exposure is also concentrated. The Federal Reserve found that the 50 largest hedge funds by gross treasury exposure accounted for approximately 90% of total hedge fund treasury exposure in September 2025. A broad market can therefore depend on a relatively narrow group of leveraged intermediaries. That does not mean those firms act together. It means the same shock can pressure many of them through similar funding channels. Now the Treasury note moves against the fund, or futures volatility rises. The futures exchange can demand additional margin, meaning more cash must be posted against the position. At the same time, a repo lender may raise the haircut or charge a higher financing rate. The trade may still converge eventually. That does not help if the hedge fund needs cash today. Leverage transforms time into risk. To shrink the trade, the hedge fund reverses both sides. It sells the Treasury security. It buys back the futures contract it previously sold. Then it repays the repo borrowing. One fund doing this is ordinary market activity. Many leveraged funds doing it together creates a different problem. Cash Treasury selling rises just as dealers are being asked to absorb more inventory. Liquidity can disappear when it is needed most. That mechanism has already been tested. During the pandemic shock, investors around the world rushed to raise cash. Treasury market liquidity deteriorated even though treasuries are normally treated as the safest liquid assets. Federal Reserve researchers estimate hedge funds sold a net $173 billion of treasuries in March 2020. Funds likely engaged in basis trading accounted for an estimated $148 billion of those sales. The problem was larger than hedge funds. Foreign official institutions, mutual funds, and other investors were also selling treasuries. Dealers had limited balance sheet capacity to absorb everything. Basis trade unwinds added another stream of supply. The Federal Reserve concluded that hedge fund deleveraging likely contributed to the disorder. This distinction matters. The basis trade did not single-handedly cause the March 2020 crisis. It amplified stress already underway. Treasury yields sit underneath ordinary borrowing costs. Mortgage rates, corporate debt, municipal financing, and many other asset prices reference the government bond market directly or indirectly. When Treasury liquidity deteriorates, price discovery becomes less reliable and yields can move sharply. A hedge fund trade that appears remote from household finance can therefore affect the benchmark used to price a 30-year mortgage. The transmission is indirect. The consequences are not. Another warning arrived after the tariff announcements of April 2025. Treasury yields rose sharply and market liquidity deteriorated as investors reduced risk. Not every leveraged Treasury strategy behaved identically. Federal Reserve data show approximately $60 billion of a related swap spread arbitrage trade unwound in April, followed by another $40 billion in May. The lesson was broader. Crowded leveraged Treasury trades can contract rapidly under volatility. If leverage creates this vulnerability, why does anyone keep funding it? Because the trade serves customers. Asset managers want futures. Hedge funds provide the other side. Repo lenders earn secured interest. Dealers intermediate the financing. Treasury markets gain additional demand and tighter pricing links. In calm conditions, every participant receives something useful. Removing the trade entirely would also remove liquidity and intermediation the market currently uses. The weakness appears when flows reverse. Hedge funds depend on dealers for repo financing and market access. Dealers also absorb treasury sales and connect clients to clearing infrastructure. But dealer balance sheets are not unlimited. If volatility rises while multiple clients demand funding, margin, and liquidity simultaneously, dealers can become more selective. A market built to distribute risk can suddenly funnel that risk through the same intermediaries. The Federal Reserve has also identified a major measurement problem. Cayman Islands hedge funds dominate much of the basis trade activity. Researchers estimated that official Treasury International capital data undercounted Cayman hedge funds' Treasury holdings by around $1.4 trillion at the end of 2024. That gap was not attributable to the basis trade alone. Other Treasury strategies also contributed. That does not mean the securities were illegal or missing. It means policymakers had an incomplete picture of who economically held them. Authorities are changing the plumbing. The Securities and Exchange Commission is expanding central clearing in Treasury markets. Eligible cash market transactions face a compliance date of December 31, 2026. Eligible Treasury-repo transactions follow on June 30, 2027. Central clearing can improve netting and risk management. But it does not make leverage disappear. It changes how exposures are collateralized, monitored, and transmitted. There is no evidence that $830 billion is automatically headed for a collapse. The trade is hedged by design. Cash, treasuries, and futures normally converge. Repo is secured by government collateral. Funds and dealers manage margin and liquidity. The central risk is conditional. A violent shock can widen the basis, raise margins, tighten repo financing, and force positions to close before convergence delivers the expected profit. Timing is the vulnerability. The system can now be followed through one Treasury note. A hedge fund buys it. A repo lender supplies most of the cash. The fund sells a futures contract against it. An asset manager holds the other side. The spread creates the expected profit. Then volatility rises. Margin increases. Funding tightens. The hedge fund sells the note. Dealers absorb the sale. Treasury yields can reprice. The same leverage that improves efficiency can accelerate the exit. Return to that Treasury note from the beginning. It looks like the safest financial object in the system, but its market price can be supported by chains of borrowed money, futures contracts, dealers, clearinghouses, and hedge funds searching for tiny spreads. The basis trade is useful because it compresses differences between markets. It becomes fragile when everyone tries to compress their balance sheet simultaneously. Safe assets can still have fragile plumbing. Follow the money. Find the power.